All right, let's jump right into this explainer. Listen, if you've been keeping even half an eye on the broader crypto markets lately, you know exactly where we're at, right? We are slogging through an extended bear market. You know the drill. Liquidity is drying up, we're seeing endless sideways trading, and honestly, retail frustration is running pretty high across the board. Navigating this kind of market rut takes a fundamentally different playbook than the one teams use during those euphoric bull runs. So today, we're breaking down the source material on one specific project to see exactly how they're charting a course through this mess. And spoiler alert, the data shows they are absolutely not just sitting on their hands waiting for the storm to pass. They are actively building the strategic, diversified shield to block out the worst of the market volatility. So the star of the show today is Bankfi, a project leaning heavily into their branding as the Bank of Cardano. Now, think about a bank in traditional centralized finance for a second. At its core, it's designed to be a financial anchor, right? A highly capitalized vault that gives you stability and predictable yield, even when the broader economy is flashing red. Well, taking that concept of a secure, unshakable anchor and dropping it into the decentralized space, specifically the Cardano ecosystem, is a massive undertaking. To be that pillar of stability, you have to build incredibly robust mechanisms that can actually survive wild price swings. It takes some serious treasury management, and that brings us right to the core problem they're trying to solve right now. Because let's be real, the current environment is brutal for Layer 1 blockchains. The reality is that Cardano, like a lot of major networks, is going through some pretty intense growing pains. When the market shrinks for this long, what happens? You see fierce governance debates, technical spats, and these highly publicized nasty arguments blowing up all over X. And honestly, a lot of smaller projects just fold under the pressure. But Bankfi's approach? It's the total opposite. They are entirely focused on deliberate ecosystem insulation. It's like they're building this massive protective moat around their operations so their yield generation isn't tied to the daily drama or the price action of the base layer token. This insulation lets the team keep their heads down, scale their infrastructure, and actually generate revenue, no matter how bad the overarching market sentiment gets. I absolutely love this quote from the team because it perfectly sums up their philosophy. We aren't the loudest, we aren't the fanciest, we aren't even with full heads of hair. In an industry that is so often driven by relentless hype cycles and flashy promises, choosing to just quietly and persistently build is a really bold contrarian move. They're basically operating on the idea that real day-to-day protocol development has absolutely nothing to do with the noise on social media. By ignoring the PR battles and just focusing on quiet utility, they're keeping their resources locked onto the things that actually improve the bottom line for their users. Okay, moving on to Section 1, the diversification strategy, spreading the risk. So how exactly do you insulate a Cardano-based project from Cardano's localized drama? The answer is heavy diversification into non-Cardano verticals. They've aggressively taken their treasury and put it into assets that have absolutely nothing to do with the ADA token. We're talking active Bitcoin mining, using independent proof-of-work setups. They're managing Spark Airnodes, which is decentralized physical infrastructure, or DPIN, providing wireless coverage. They even hold tangible, real-world assets like Bourbon. I mean, Bourbon has entirely different appreciation mechanics than crypto, right? Plus, they've got infrastructure investments like Unity nodes. The strategy here is crystal clear. If Cardano governance stalls out or the price of ADA takes a dive, their Bitcoin miners and physical assets just keep humming along, generating revenue like nothing happened. Which brings us to Section 2, delivering record yields, the execution. Now, a defensive moat sounds great on paper, but to actually play offense, you have to deploy capital. And recently, right in the middle of this market run, Bankfi dropped 7,000 USD to grab more Spark Air nodes. But here is the kicker. The most important part is how they funded it. They didn't just go out and raise this from new users. This was driven directly by compounding their existing yields and internal unit purchases using a chunk of capital from their own Islanovo Bankfi fractionalized units. It's a real-time compounding loop. They're taking revenue from their diversified setup and aggressively plowing it right back into hardware to boost future cash flow, completely ignoring whatever the token prices are doing that day. And they didn't stop there. They followed that up with a massive $20,000 deployment in total market buys aimed squarely at their world mobile vertical. Out of that, $13,000 was dedicated strictly to buying up HSKN units, a specific ecosystem token they use. Listen, injecting tens of thousands of dollars of fresh liquidity into yield-generating assets during a major market contraction, that is a huge flex of treasury health. While everyone else is retracting, selling off, or just going into hibernation, Bankfi is out there aggressively scooping up market share. They're basically locking in a much higher baseline of yield for their users for when the macro conditions finally turn around. Now, alongside buying up all this physical infrastructure, they're also managing the rollout of their internal tokenomics. The Knight token timeline is built as a highly structured, long-term distribution. The first drop is already in the books, and recently, with a key project lead named Jake coming back, the team officially pushed the second quarterly drop live directly to users on the Bankfi platform. Doing this quarterly with 2 more drops still to come is a really smart economic move. It keeps token inflation in check and makes sure early adopters stay engaged over a multi-month period. It's way better than doing one of those massive single unlock events that almost always lead to the token getting instantly dumped on the market. And all this strategic positioning culminated in a brand new ADA reward distribution record during the projected June 2026 cycle. Wait, achieving record yield payouts when the actual price of ADA was dropping and the Bitcoin halving was squeezing mining margins? Yep, and how they pull that off? Through highly proactive treasury management. Instead of just passively sitting on the assets they generated, leadership made the call to execute their yield conversions super early in the month, right before a major ADA price dip. By timing those currency swaps perfectly, they locked in way more ADA per dollar of yield, completely shielding their users from the market slide and securing those record payouts. It's honestly a masterclass in timing. Now, let's look at the actual operational data here, because it shows something really impressive. Incredibly wide community participation. Keeping user counts high in niche DeFi protocols during a bear market is almost impossible. But look at these numbers. You've got 608 eligible users actively in the Bitcoin mining vertical, and another 586 users holding units in World Mobile. And the Genesis NFTs, which are basically baseline ecosystem access, have 718 eligible users holding over 117,000 units. This proves something absolutely crucial. This yield isn't just being hoarded by a tiny handful of insiders or massive whales. These diversified returns are flowing out to a huge, engaged community holding thousands of fractionalized units. And when you compare the yield across these different buckets, the sheer revenue power of physical infrastructure becomes crystal clear. Check this out. The baseline Genesis collections are yielding a modest 0.058 ADA per unit. But the verticals backed by actual physical hardware, they are generating exponentially higher returns. The mining vertical kicked out 3.654 ADA per unit, and the world mobile sector is just an absolute powerhouse, dropping 12.311 ADA per unit. This massive difference totally validates the team's entire strategy. Pushing capital into real-world deepen and proof-of-work mining simply creates heavier, more reliable rewards than just issuing standard ecosystem NFTs. The biggest rewards are flowing straight from the most robust external utility. And look, when you execute consistently like this, user retention naturally follows. The data shows that out of 150 total top-tier holder passes that exist, 134 of them are currently staked and locked up on the platform. Staking is the ultimate indicator of trust, right? People are willingly locking up their liquidity because they expect future returns. And the protocol definitely rewarded that trust, distributing a massive 39.197 ADA per staked pass. Maintaining nearly a 90% retention rate among your top-tier holders while the rest of the market is in turmoil, that is a huge sign that this community heavily values real execution and insulation over quick, short-term trades. So let's wrap things up with Section 3, the future of Bankfi. Looking at all this Bankfi source material, it really leaves us with a much bigger takeaway about how we should all be evaluating DeFi projects from here on out. The data is practically screaming that supporting projects focused on cross-chain infrastructure and real-world asset diversification is a way more resilient strategy than just holding a basic single-chain utility token. By building that protective moat and aggressively compounding real yield, protocols can actually thrive while everyone else is shrinking. So here's the question I want to leave you with. When that next macro bull market inevitably kicks off, are these insulated, diversified projects that are setting yield records right now going to completely leave traditional single-chain assets in the dust? It definitely makes you rethink valuing a project based on its Twitter hype instead of its tangible revenue, doesn't it? Thanks so much for joining this explainer. We'll catch you on the next one.